For the last 2 decades, the Indian IT services industry has been one of the most reliable engines of growth in the global market. Its business model was simple, effective, and incredibly profitable. Supply skilled technology workers to the US at a fraction of the cost of local hires. This strategy turned companies like TCS, Infosys, and Wipro into household names for investors worldwide. But what if the very foundation of that business model was suddenly shattered overnight? That's exactly what just happened. A new rule means companies might have to pay $100,000 for every H-1B worker every single year. This isn't a typo. This new, massive fee completely changes the game. The market's reaction was immediate and brutal. The top 4 Indian IT firms lost a combined $14 billion in stock value in just a few hours after the news broke. Today we are breaking down how this huge new fee will hurt company profits, which stocks are in the most danger, and what smart investors are doing next. This is a major change, not a small bump in the road. It's not just about extra costs, it fundamentally breaks the business model for a large part of the tech industry. It is critical to stay tuned because a smaller company is in serious trouble as 70% of its US workers are on H-1B visas. It's a major red flag that can't be afforded to be ignored.
Forgetting the complicated government language, here is what this means. Before, it cost a company about $7,000 total to get a 3-year H-1B visa for a worker. That was the normal cost of doing business. Now, the government wants to add a $100,000 fee every single year for each visa. The math is simple. One engineer on a 6-year visa used to cost the company around $7,000. Now, that same engineer could cost over $300,000. That's a massive, game-changing increase for companies that build their business on the old, lower costs. To make matters worse, the new rule also gets rid of special treatment for workers with master's degrees. This means every visa application is now in the same big lottery, with only 85,000 spots available. There are no more fast tracks for the highly educated. To be clear, there are no exceptions. Companies can't get a discount for hiring many people, and this rule applies to everyone. Lawyers for the industry are planning to sue the government, saying the fee is unfair because it targets one specific group of workers. But a lawsuit could take over a year to resolve, and this new fee starts in just 60 days. This means companies have to find the money for these fees now, even if the rule gets overturned later. It's a pay now, argue later situation that is already causing panic.
The stock market doesn't wait for lawsuits to finish. It reacts instantly to news. Within minutes of the announcement, automatic trading programs started selling. Infosys stock fell 7.3%, Wipro dropped 6.9%, and HCL Tech went down 5.8%. Even TCS, which relies less on these visas, fell nearly 5%. To put that in perspective, these drops are about 3 times larger than a normal bad day for these stocks. This wasn't investors looking for a bargain. This was a rush for the exits. Wall Street analysts quickly estimated that if companies pay this new fee, their profits could fall by a massive 2.5 to 4%. A drop that big would simply wipe out a huge chunk of their earnings. There was also a lot of activity in the options market, which showed that professional traders are betting heavily that these stock prices will fall even more. For anyone who doesn't follow options, it means the experts are convinced that this is a real, long-term problem for these companies, not just a temporary dip.
Relying on H-1B workers is not just a small part of the business for Indian IT companies. It's the entire foundation of how they work. For a typical project, a company might have 30 engineers working at a client's office in the US, supported by 100 more developers back in India. Having workers on site in the US is critical for winning big contracts because it allows them to meet security rules and work closely with the client. If they can't use H-1B workers, they have 2 bad options. First, they could hire American workers, but that would cost 2 or 3 times more. Second, they could move all the work back to India, but they risk losing clients who want their teams nearby. Either choice would cause the healthy 18% to 22% profit margins that investors love to shrink down significantly, probably into the mid-teens. And don't forget, these companies are already dealing with other financial challenges. They are paying their workers in India more due to high demand, and changes in currency exchange rates are also eating into their profits. Adding this massive visa fee on top of all that is like asking someone to run a marathon right after they've given blood. It threatens their entire business model and forces them to rethink how they operate in the US.
A look at public data reveals how much each company relies on H-1B visas and which will be heard the most. Wipro requested about 4,200 new H-1B visas last year, which is 38% of its total US staff. The new fee would add $420 million to their yearly costs. Since their profit last year was $1.8 billion, this new cost would wipe out 23% of their earnings. Tech Mahindra requested 3,300 visas, or 34% of its US workers. For them, the hit would be $330 million. With a profit of $1.1 billion last year, that's a massive 30% drop in earnings, which is even worse than Wipro. Infosys looks a bit safer. They requested 5,000 visas, but that's only 18% of the US workforce. Still, the new cost would be $500 million, which would reduce their profits by about 11%. It's a big hit for a company of its size. HCL Tech requested 2,400 visas, or 15% of its US staff. This would cost them an extra $240 million, or about 8% of their profit. It's a problem, but not a disaster. TCS made a smart move by hiring more local American workers over the past few years. They only requested 1,500 new visas, which is less than 10% of the US team. The cost to them is about $150 million, which is only a 2% hit to their profits. They will be fine while their competitors are in serious trouble. The situation is even more dangerous for mid-sized companies like Persistent Systems and L&T Technology Services. Over 40% of the US workers are on H-1B visas. Unlike the big firms, they don't have a lot of extra cash to absorb such a huge new cost. Anyone owning stock in these companies should be very careful. And that small specialized AI consulting firm, its stock is already considered expensive. The problem is that a third of its income comes directly from H-1B workers. When those workers become much more expensive, the company's profits will plunge and its stock price could get cut in half.
So, what can these companies do to survive? They have three main options. Move more work to India. This is the traditional solution. For example, a company could try to move more of its US client work to its offices in India. However, clients will likely demand lower prices in return, and some sensitive projects simply can't be done remotely. So this might save money on visas but could lead to lower income. Move work to Canada and Mexico. This is a very attractive option. These countries are in the same time zone as the US and have friendly business laws but without the high visa costs. Companies like Infosys have already started building offices in Canada, and we can expect them to move much faster now. This is a smart pivot that many companies will likely make. Use more automation. This is the long-term solution. Using new AI tools to write and fix code can reduce the need for human workers. If a company can automate 20% of its work, it can regain a lot of its lost profit. The problem is that everyone is rushing to do the same thing, and the companies that sell these AI tools are raising their prices. It's a good solution, but it's not a quick or cheap fix. There is also the possibility of a lawsuit. A major industry group is preparing to sue, arguing the fee is unfair. A judge could temporarily block the fee, but these cases move very slowly. Companies can't afford to wait for a legal miracle. They have to plan for the worst-case scenario right now.
This H-1B rule change creates losers, but it also creates winners. Canadian IT companies like CGI could get a lot of new business as clients look for talent in countries with less drama. US-based IT companies like EPAM and Globant also win. They were always more expensive because they hire American workers. Now, with the cost of visa workers going up so much, these US companies suddenly look much more competitive. On the losing side, besides the big Indian IT firms, are many tech startups in the US. A lot of these startups have been using cheaper H-1B workers to keep their costs down while they grow. A sudden jump in labor costs could force them to lay off staff, struggle to find new funding, or even go out of business. This is a major risk for anyone investing in private tech companies.
This raises a question.
Is it shocking that the IT industry is this vulnerable? Or was this foreseeable when companies like TCS started hiring thousands of Americans directly from local colleges? Share your thoughts in the comments. And for an updated list of which companies are most at risk, hit that subscribe button and turn on notifications to not miss the next update. Things are changing fast, and staying informed is crucial.
Here's the bigger picture. For decades, the Indian IT industry's main selling point was offering skilled workers at low prices. The H-1B visa was the key that allowed them to bring those workers to the US at a huge cost advantage. Now that this advantage is being wiped out by a $100,000 fee per person, the entire business model is broken. In the future, the most successful companies will be the ones that sell their own technology, like software platforms, AI tools, and other unique products, instead of just renting out their employees' time. As an investor, it's time to start paying attention to how much a company spends on research and development, R&D, not just how many employees it has. The companies that invest in creating their own technology will become stronger and more valuable. This is a painful but necessary evolution for the industry. To sum it all up, this new H-1B fee is a massive earthquake for the IT services industry. Wipro and Tech Mahindra could see their profits fall by over 20%. Infosys and HCL Tech are also facing double-digit profit hits. TCS is the only one that will escape with minor damage thanks to its smart strategy of hiring locally. Stock prices have already started to fall, but the real damage will be seen in the next few months when companies are forced to announce lower expected earnings. For those who own stocks in this sector, it's time to make some changes. Consider selling shares in the companies that are most at risk, those that depend heavily on H-1B visas. It might be wise to switch to companies that are better positioned to gain, like those with a strong US workforce. Most importantly, keep some cash ready. There may be more bad news and better opportunities to buy later. And regarding that small AI company with the expensive stock, remember, a business model built on a shaky foundation can disappear overnight. Be careful and stay informed.